Welcome to this Killick Explains video, and I guess this video is all about scene setting for investors, and I want to cover essentially why volatility is going to be a feature of 2024. Absolutely a given, doesn't need to necessarily impact the way you think about markets and investing. Okay, so a bit of background here. 2023 was surprisingly strong in the end after quite a lot of volatility in the first half of the year. The second half, especially towards the end, the final quarter, markets picked up, technology stocks rebounded, and even the small cap market, which had been pretty dead for much of the year, showed some signs of life, tentative IPO recoveries, that's companies coming to the market, and so on. Okay, thing is, got to be careful with markets. Just when you think you've got the hang of where they're going, they can throw in surprises. And first quarter of 2024, some inflation data came out that worried the markets, and we got some volatility. So what I want to do is paint a picture here. Be careful. There are reasons to not just assume that the exuberance we saw at the end of 2023, for example, is going to continue. Not the way the markets work. So things we've got to watch out for. China. All right, so being specific, China is a big one. Debt levels in China are a bit of a worry. Now, on the latest data snap, and this will be out of date as you watch the video, but you get the picture, bank loans total something like 33 trillion outstanding versus the US around 2/3 of that level. So what we're saying is there is a lot of debt outstanding, not yet repaid across the Chinese economy. All right. Then you've got worries about the property market. Then you've got fears that they might or might not do something around Taiwan, one of the world's critical, if not the critical, hubs for semiconductor chips and so on. And of course, you don't need me to say Russia, Iran, North Korea, and of course China. People are saying, are we seeing the emergence of some kind of global south, which ultimately could challenge the dominance of the West, NATO, and so on. So there are plenty of reasons to remain nervous around China. And I suppose Putin's Russia has shown what happens if you get too complacent, potentially. Then, China's just one thing on my list. There are refinancing risks, as I call them. Right now, this is just the fact that a lot of people think interest rates may have peaked last year, may have peaked. Got to watch the inflation data, got to watch shipping and freight costs like a hawk. Okay, and therefore, are we going to see interest rates start coming down? Maybe. Okay, but the point is the cheap debt era, as I would call it, is definitely over either way. The 20 years when interest rates were zero is not about to come back. And that is still, even with inflation coming down, sort of, not good news for individuals, companies, and governments. And what I mean by that is, it's all very well. Let's say inflation and interest rates do start to creep down. Quite a lot of people this year will be having to re-lock into arrangements they made several years ago, whether those arrangements are mortgages, previous borrowing by companies, previous debt issues by governments. All right, so a range of organizations of people are going to feel the pinch in their pockets, even if in the short term, even if inflation and interest rates come down a bit. Then there's regime change. This is geopolitics. Now, markets are quite good at seeing through geopolitics as a rule of thumb. Crikey, we've had wars in Ukraine, wars in the Middle East. Didn't stop the markets rising in 2023, but nonetheless, even if we could overlook, which I suggest we can't, Ukraine and the Middle East, leaving that to one side, across the Western world, huge regime change in the next 18 months to 2 years. I hardly need to tell you, we've got US elections with the possibility that Donald Trump will be back in town. The UK, the Tories seem to be doing a good job of imploding, could have regime change here. There have only been 6 Labour governments ever. We could be looking at another one soon. Across Europe, who knows? The emergence of the right wing again as the economy, European economy is not in a good way. Germany's not in a good way. That's got to be watched. Japan, elections there too. So there's going to be a lot of change. I'm not going to say chaos. It's not necessarily a bad thing, change, but there is going to be a lot of change. So that's another thing that can upset markets. Then there's liquidity. All right. And yes, interest rates maybe, I stress maybe, are on the way down overall in 2024. Not at the same speed around the world, you get the idea. But behind the scenes, central banks are pulling another lever, which actually almost has the opposite effect, which is quantitative tightening. All right. So what's happening is, and this hasn't stopped, central banks are thinking we basically were quite generous, to put it bluntly, with money, if you want to see it that way, whilst there was a pandemic on and various other things, and that lever is being pulled back. It's called quantitative tightening. I cover it in more detail in another video, but that's a separate way of squeezing liquidity to interest rates. All right. And so far, it hasn't affected commercial bank reserves. Now, you're thinking, what's he talking about now? So far, the impact's been muted, but the reality is that a certain amount of liquidity could be pulled out of the market in 2024, and that will have ramifications for markets. It will make markets nervous. Won't necessarily cause them to go into a nosedive, it makes them nervous. And then there are the unwatched pots, and markets always look for surprises, if you like, the thing they didn't see coming, and they try and second guess what it might be. So we could get an inflation shock. Not saying we will, but maybe inflation will be stickier than people expected. There could be a blowout somewhere. Now, where it will be, nobody knows, but there's speculation around the car loans market, for example, junk bonds. Hopefully, none of those concerns, will morph into anything too serious, but there's always a left field factor out there somewhere. Economies could drag us down a bit. I mean, jobs data is suggesting that the jobs market is starting to contract despite wages rising. The underlying economy in Europe, for example, is pretty weak right now. And whilst the economy and the stock market are not the same thing, they look at different time horizons. One can eventually influence the other. But as an investor, what do you do with all this, all these reasons to worry? The reality is you stay sanguine, all right? Once you realize, as Warren Buffett put it, that volatility is a given, it's the price you pay for long-term returns. There are no free lunches in investing. If you want the kind of returns that stock markets have shown they can put in over decades, in the short term, you've got to be able to live with volatility. It's just the way it is. So no sudden moves. Whatever happens next, where the markets rise, you don't suddenly pump money in. There's a panic sort of, I missed out reaction. If markets fall, you don't pull it all out again. All right, it's all about having a steady mindset when it comes to dealing with the short term. Okay, so there we have it. Reasons why volatility is going to be with us, probably for the rest of time as far as investors are concerned. For more information on that, killick.com/learn. How to invest in equities, that's got a bit in it, editor@killick.com, the light blue cover, one of 6 guides. And there's Confidant, our quarterly magazine, which deals with this issue. My colleague Rachel Winter in particular in the latest spring issue, and that would be editor@killick.com.